Yeah, for those joining us here, we're shaking things up a little bit, and we're doing our Mortgage Insiders edition here on Facebook Live. And we thought it'd be a really relevant time to do it, especially with the crazy announcement that Bank of Canada just dropped us with. Of course, we'll shed some light into what that announcement was, but the plan today is that Preet and I are actually planning to kind of break it down. We're going to break down what happened yesterday with Bank of Canada, why it's so important for you guys to kind of know, and what our predictions are like surrounding this, right? Like what's to come, what's our advice that we're giving to our clients. So I guess like to start it off, I mean, Preet, that was a pretty major day, right? I think we all knew everything was coming. We knew that Bank of Canada had no choice but to increase it. But I think the main question really was how much, what the next steps are going to be, like what kind of tone. And I think we were really all on the sidelines waiting on that. So for those of you watching, tuning in right now, Bank of Canada released another 75 basis points drop. So just to kind of clarify for those of you who are watching, this will impact anyone who has a variable rate mortgage. Okay, so if you have a fixed rate, do not worry, do not stress out. This does not impact you. This is purely only for those who are in a variable rate mortgage. Now, what comes in a unique time is that when it comes to a variable rate mortgage in Canada, there's always two types. So it's either you've got a static variable rate mortgage or you have an adjustable. If you have an adjustable, just know that your payment will go up. So pretty much anytime there's an increase, your payment will go up accordingly. But if you're in a static variable, of course, the allocation between principal and interest will change. But what's really unique about this Bank of Canada increase is that some of you may be impacted where you're going to hit something called the trigger rate, which will automatically prompt you. You know, your lender will prompt you, will call you, give you a notification saying that, hey, you may have to come in, do a lump sum, or perhaps even convert your mortgage to a fixed rate term. Again, depending on lenders. So, I mean, Preet, like, what's your, like, break down the changes and what you think is going to come out of this? Like, why do you think they did this? And also, like, what do you think the future holds? Like, is this going to be the end? Like, are we going to see more? Like, what are your thoughts on this?
Absolutely. So welcome everybody to Mortgage Insider Edition live version over here. This is our first one, and this first one is basically, the live one is basically dedicated to the rate increase that happened yesterday. As Kim mentioned, 0.75 percent went up. So first of all, I would like to clarify, I have seen some posts yesterday from a few of realtor friends, and I have some people also, clients calling me and confused about the wording between the rate hike and everything. So the Bank of Canada increased their overnight lending rate or overnight target rate by 0.75%, which earlier it was 2.5, now it is 3.25. So our clients should not confuse that 3.25 with the prime rate. The prime rate offered by the banks, TD, Scotia, ATB, anybody else, CIBC, is different. It's normally 2% higher than the overnight lending rate or overnight target rate. So if you're reading 3.25, that is not the prime rate offered by TD or Scotia or anybody else. That is the rate, overnight lending rate from the rate where the bank is getting the money from Bank of Canada, any bank. So then moving further, when you add on the 2% basically to it, then, or roughly 2% to it, then today's prime rate as of today is 5.45. So earlier it was 4.70. Day before yesterday it was 4.70. When it went up by 75 cents, it became 5.45. So answering your question, Kim, what I see, what I heard from, or what I'm reading online, and I'm pretty much sure you would also hear the same thing, is this is not the end of the interest rate hikes. First of all, this is not going anywhere. It will stay with us, these interest rate hikes. What I've heard is minimum, there would be more coming in. Minimum by the end of this year, there is another one more rate hike coming in. And the government's or Bank of Canada's target is that they will make the overnight lending rate, the rate that is 3.25 today, they will bump it up to 4%. So I wouldn't be surprised if in October or December, if this rate goes up from, let's say, 3.25 to 4%. And if we look this prior to many years ago, those people who have been doing mortgages or have been taking mortgages in the past, let's say 7 to 8 year window in the past, this rate was very common. This was nothing new. This rate was very much like used every day. 4% as the overnight lending rate, and 2%, 6% was basically the prime rate. And when I got my first mortgage at that time in 2006, the prime rate was 6%. So this is common. What other things that I've heard is it will definitely slow the market. Definitely, this is going to break the backbone. I'm not sure if it would be a soft landing or a hard landing, but the Bank of Canada, this announcement did not talk about the soft landing in this announcement. I think they were um, over forecasting, and you know me, both of us know that in the last so many years, in 2021, they were telling us that they will not even raise the interest rate for 1 year or 2 year window, and now suddenly they are going instead of rapidly, basically gradually going up, they are going rapidly up. And same thing what they did in 2020 when COVID came in, they rapidly decreased those interest rate, which pushed the inflation so high. The inflation is the biggest story as of today, whether we talk about Canada, whether we talk about US. Inflation in the last couple of months has come down in Canada from 8.1% to 7.6%, but it only came down because the energy prices across Canada have, or across the world, have gone down. And if you see, the same thing is happening right now on our gas prices. They're a little bit better than in the last year, right? The last few months, right? So coming back to what the predictions are, this will stay. Like there is a rate hike, probably one more rate hike coming in.
Mhm.
So Kim, I will stop over here and I will flip the camera back to you. What do you recommend as of today? Uh, should our clients go with a variable rate? What do you think? A
Mhm.
fixed rate? What's your take on it?
Honestly, it's such a hot topic and it's like the million dollar question, right? And I'm sure everyone can sympathize here. Us as mortgage brokers, I think the past yesterday and today have been filled with phone calls of what do I do now? Like with this change, like what is right for me? And my model and my what I tell my client has never changed since day one, right? Even before this whole rate increases and stuff. It really, really boils down to more so of your plans, right? And your goals with the home. Because again, yes, the variable rate has gone up, but again, it is still a great product. Like it is, like many Canadians always fail to forget and look at the bigger picture, which is variable rate. One of the benefits of it is if you ever needed to break the term, your penalty is only 3 months interest. So even though rates may be going up, if you're finding yourself in a situation where you may want to sell your home, you may want to break the mortgage, or you need that flexibility in case of anything, stay the course with the variable rate. Because if you need to break it, 3 months interest is an easier pill to swallow than if you were to take a fixed rate term. When you're taking a fixed rate term, always remember that your penalty is going to be based on the interest rate differential, right? Either that or 3 months interest, whichever is greater. And in most cases, the interest rate differential is greater. And we see penalties anywhere ranging from 2.5 to as high as 4.5% of your mortgage balance. It's significant, right? So again, though, but if you're the type of person that you can't sleep at night knowing that, okay, these rates are going up, like I just, I really can't sleep at night, I'm really uneasy. I'm always a firm believer of your sleep and your sanity is more important than some interest rate, right? If that's what
Yep.
it takes for you to go to bed at night, then convert it. But if you are planning to convert it to a fixed rate term right now, just for that stability, don't take anything longer than 3 years. I would say 3 years is going to be your max, but even at that point, you're pushing it, right? Because the way
Yep.
everyone has to remember that rates go in cycles, right? There's always periods of up and down, and you have to remember that. You can't be so narrow and so focused on the fact that it's so high right now. It will come back down. It's just a matter of when. But the thing is that if you want to convert, this is where you don't want to get caught because you don't want to lock into something like a 5 year, 4 year. You don't want to go too long because we know that with these drastic changes, and I'm sure Preet, you probably agree too, a recession is going to come. We've lived through a recession.
It is.
We've seen it.
Definitely.
We've seen it.
Yeah.
And every time a
It,
recession hits, what happens to rates? They go back down. So really, as a
go back to
smart
them.
investor, right? Smart investor, someone holding a mortgage right now, you want to be cautious of that. You want to be mindful and you want to time the market as close as possible as you can. So that's why if you're taking shorter terms, 1 year, 2 year, 3 year, maybe, right? By the time that your renewal comes up, you should be in a lower rate environment compared to what we have currently. And that's kind of what I'm saying. Would you, I think Preet, you probably have the same sentiments, right? With what you're saying.
Absolutely, absolutely. If somebody would have asked me like 2 days before, and again, these rate predictions are basically the rate hikes that our forecasters are always done. Sometimes they are wrong also,
Mm-hmm.
but now we have seen that this has happened already. So if somebody would have asked me 2 days, 3 days ago, when the variable rate was still better, I would have still advised my clients to write it out as much as they can with the variable rate.
Mm-hmm.
But now I think yesterday was a turning point. Now things will change. Now variable rate market will be basically the what I have heard. Dr. Sherry Cooper is one of the biggest economists within Canada. She was an ex-economist with Bank of Montreal. I was listening to her podcast today, and what her prediction is that in the next, as you said, in the next 2 to 3 year window, things will change. It may be sooner, it may be somewhere in 2 to 3 year window. So her point was variable rates will now go up more faster than the fixed rates. It's called as the inverse strategy with variable and the fixed. There is something with economics about that, but I don't know the whole story. But again, their point is, as you said, Kim, is 2 year fixed or a 3 year fixed is the maximum that you should basically, if you really are worried that you do not want to go with the variable, then go with the 2 year fixed or a 3 year fixed. But if you are thinking to sell your existing home or your renewal is coming up and you're thinking to sell it within 6 month window or 1 year window, then maybe go with the 1 year fixed, or maybe let's say go with the variable and write it out, like add the numbers and keep it in a variable, keep a tab on those numbers. As Kim mentioned earlier, we would advise you to make lump sum payments if your mortgage allows you to, other than anniversary rate, increase your payments and write it out. The main thing is you have to be very diligent and about the whole mortgage process. You have to keep tab on it.
Mm-hmm.
Other things that definitely were mentioned in the podcast, I will refer to the Sherry Cooper's podcast, was that economy will slow down. Yes, the housing prices will come down, but it will not come down that much that people will be throwing away their keys. It will not happen. So that strong market, or let's say some fair market, will still stay there. Yes, we may not see it boom, but a consistency will be there. Like first-time home buyers market will slowly keep moving. That kind of stuff will still happen. Kim, do you have anything else to add? What do
Yeah,
you?
I think like, for anyone who's watching now or later on, just know that if you come to a point where you're wondering, okay, I don't know if I can handle these payment increases anymore, maybe, it becomes a matter of, okay, affordability is getting a little bit tight. There are other alternatives, right? It's not the end all be all that you have to convert to a fix. Perhaps it's looking at other solutions like, okay, maybe we need to extend your amortization, right? Maybe we need to look into refinancing sooner so that way we can consolidate some of your debt and then re-extend your amortization to a longer period. So just remember, like in Canada, the longest amortization period with a Schedule A bank is essentially 30 years, but there are lenders out there that will allow to go past that if need be, right? So just know that there are options. And again, if you're feeling you're in that kind of situation, reach out to your mortgage professional or reach out to one of us. We'd be more than happy to kind of guide you, do a full like budget analysis of where you're at right now. See if there's any way we can kind of trim the fat off. And most of the time too, sometimes it's consumer debt that you have, like credit card debts or something that we can easily roll in to make things more manageable. And on top of that, if we can roll things into your mortgage, and if you have that extra cash flow, you can always apply that extra cash flow towards your mortgage, which effectively will shorten your amortization. Because I know sometimes when I bring up the conversation of extending your amortization, people are like, no, Kim, like I don't want a mortgage for 30 years, right? But just keep in mind any dollar that you put on top of your, monthly obligations towards your mortgage will effectively cut down the amortization, right? It's just for cash flow purposes. But there are options, there's solutions, maybe even looking into like a hybrid solution of getting like a HELOC where some of it is interest only payments to kind of help. Like there's a lot of creative solutions out there, but just know that you got to ask, right? Like just let us know. Happy to walk through the whole thing. It's confusing times right now. It really is. Because I feel, anyways, Priya, I'm sure you feel the same way. The message is different. If Preet, like, we could probably rewind the tapes to when we first talked, like, 9 months ago, like back in January. Who would have thought that this was the outcome? Look at how much has changed
Yeah,
throughout the time. So just know that we kind of have to roll with the punches, but this is kind of where during this time is when you really need to lean into a mortgage professional to really help guide you through this because there's a lot of noise out there. So purpose of this live video is to kind of cut that noise as well too, right? Just give you like the facts that
yeah,
you need to be worried about, what you need to pay attention to, and take it from there.
absolutely. Okay. Thank you very much, guys, for tuning in. Until next time, we will keep adding on more value towards you and basically advising you if there are any other changes coming up. And until next time, thank you very much. Thank you for watching.
Thanks, everyone.